Hey, Michael, how are you?
Hey, Michelle, how you doing?
Good, great, thank you. Michael Abram from RPM Mortgage. I'll let you introduce yourself.
I've been a direct lender since 2006. I work with over 80 different FDIC insured banks. Been doing this a long time and been able to offer clients a lot of different programs for a very long time.
Great, thank you. So I wanted to have a little talk with you today and talk about interest rates because it's been kind of the buzz on the street in the real estate
Mhm.
market. So I just wanted to go through a few questions.
Sure.
So first of all, where were the rates a few months back, and kind of like where they are now, and what has influenced them?
Sure. So around mid-December 2021, we had rates that were still in the low 3% range, maybe 3.5 or higher for some higher price loans.
Uh-huh.
And then around mid-December, we started to see rates going up, mainly due to inflation concerns, oil price concerns, and then all of a sudden the potential war with Ukraine and
Of course.
Russia causing a lot of turmoil in the market, but mostly inflation. That's really
Right,
the
right.
biggest cause.
Right. And so we heard recently about the Feds increasing the rates officially by a quarter of a point. They've talked about subsequent increases, which we'll talk about in a moment. And so in the consumer's mind, the natural reaction is that, oh, well, if the rates increase the rates by a quarter of a point, it means that the bank rates are going to be higher by just a quarter of a point, maybe from 4% to 4.25%. But in reality, the bank rates are really more affected by the 10-year treasury bond, and the increase is actually much larger than just a quarter of a point. Do you want to
Yeah.
explain that a little bit?
Yeah, so that's more closely tied to the federal funds rate. That's the rate at which banks buy and sell to each other and impacts things like home equity lines, HELOCs, credit cards, more short-term loans. The longer-term rates like adjustable mortgages and 30-year fixed, those are tied to the 10-year treasury. Does not mean that the banks didn't factor in this rate hike into their analysis for rates. They absolutely did. It just wasn't a driving force to why the rates went up.
Right. So we're having you're dealing with, I'm sure, a lot of times with buyers who are getting pre-approved. All of a sudden, they thought they were going to be maybe like in the mid to high 4% interest rates, and now you're seeing like things in what range?
Conforming loan, basically 647,000 or less, you're in the high fours, 4.875, 4.75, somewhere around there. If it's higher than that, like 648 to 970, expect it to be about 5.5% on a 30-year fix.
Wow.
So a lot of banks are starting to price loans as jumbo loans. Those loans are pricing better than Fannie and Freddie high balance loans.
Okay, so just to repeat real quick, because we were cut off just a little bit, but in California, and it depends, it varies, in every state, but in
Mhm.
California, because our real estate prices are so high, the conventional loan limit is $647,000, and so any loan up to $647,000 is considered a conventional loan. Anything above $647,000 is considered a jumbo loan, and then you go into a higher rate, probably right now in the mid fives versus
Yeah,
the mid to high fours in the conventional limit. So
yeah, that's correct.
it's quite a jump. It's quite a jump. And then, so what effect is it having on people's, pre-approval in terms of their purchasing power and their pre-approval status?
Yeah, so I mean, you would expect that people's ability to purchase is dropping because rates are up, squeezing their ability to qualify at higher price points,
Right,
and prices are not correlating to that. They're still going up.
right. So their purchasing power is going down.
Mhm.
And obviously it seemed like it should have an effect also on prices, and prices coming down. But we're not sure really if that's going to happen or not. What's your take on that?
Yeah, I think that we'll start to see some stability to the pricing towards the latter part of the year, end of Q3 into Q4. There's a lot of concerns right now with the inverted yield curve, indicating there could be a recession on the horizon in the next 24 months. And
Right.
certainly that's going to be taken into account. And I do think it will start to correct itself. And with the rates going up, you're going to have less buyers. That's just the reality. People can't afford as much. So that's
Right.
going to impact how many buyers are looking in certain price.
Right. Right. So I think the word out there from the so-called experts is that the increase of interest rates is going to put a damper on many buyers' budget. It's going to lower their budget. Therefore, it should have an impact on the sales price, where there's not going to be as many buyers able to afford these really high prices, and therefore sellers may have to lower their prices. So far, we haven't really seen that too much. Maybe it's going to slow down the increase, so prices won't go up as fast as we've seen in the past 2 years during COVID. But as of now, prices haven't really come down that much. Can you tell us briefly about the value of, or the difference between being pre-qualified and pre-approved, and what can people do to, to go from one to the other and be best prepared to put an offer on the property?
The pre-qualification is really nothing. It's just running an application and a credit report. Nobody's going to put any weight on that. Pre-approval is where I'm doing my due diligence. I'm looking at income, assets, credit, looking at your app, making sure I've seen all the pieces. But right now, that's just not good enough. Everyone's wants a little bit more, close a little bit faster, have buyers lift their contingencies. So you've got to be fully approved on pre-approval.
Right. So it sounds like you would recommend that if a buyer or buyers want to start looking for a home, the pre-qual doesn't have much value. The pre-approval is where they've actually supplied all their documentation, their financial documentations to you, and you've run it through underwriting. Is that right?
Mm-hmm. That's correct.
And basically they are pre-approved, short of just having found the actual property and doing an appraisal of the property.
Exactly right. We know all the conditions, and now we can close faster than 30 days, write offers with no contingencies, and you're just as good as a cash offer, and you're better than all the other financing offers.
Right. So this is a really huge point that you just made right now. They're just as good as a cash offer. They can go in without a loan contingency. They still need to have their appraisal contingency, because at that point, they don't know which house they're going to be putting an offer on. But it'll give them a huge advantage versus another buyer or other buyers who are just pre-qualified, where they can make an offer without a loan contingency and have a much better chance to get their offer accepted in this very competitive market.
Absolutely correct.
Great. Well, listen, Michael, this has been really helpful, really informative. I know you deal with, pre-approving buyers all the time, and so you're really in there in the trenches. I really value your input. Anything else you want to add to this?
No, just make sure you're getting advance approved. That's all I can say. I see it every day, and
Absolutely.
I preach it every day, and I feel like you're wasting your time if you're not doing that.
Absolutely, 100%. Well, thanks for talking with me. I really appreciate it, and we'll see you in the next video. Take care.
Sounds good. Take care.